Hello class, welcome to Chapter 1, Goals and Governance of the Corporation. In this chapter, we cover investments in financial decisions. What is a corporation? Who is the financial manager? Goals of the corporation. We talk about the agency problems, and we turn to the executive compensation and corporate governance. Turning to a little bit of ethics, of maximizing value, careers in finance, and previews of coming attractives, and a review of financial history. Okay, now let's turn to investment in financial decisions, capital budgeting decisions. In this course here, 500F, this is a introduction to finance. You'll receive much more background and readings in capital budgeting, but we will touch on it in this course here. So you're going to make decisions such as what to invest in, such as American Airlines could invest in new planes, which is a tangible asset. Of course, tangible assets are things you can touch and kick. Or someone like Abbott Labs would invest in intangible assets such as research and development or R&D. Okay, here's another slide. Two examples. I gave another airlines here, but Southwest Airlines purchasing new planes, and an intangible, another pharmaceutical company investing in an intangible asset of R&D. Okay, turning to financial decisions, you have to decide, the company's going to have to decide the source of how they're going to raise the money and the amount of financing. Of course, this goes along with the capital structure, which we'll touch in this course, the mix of how much debt or long-term debt and how much of the money will be from equity financing or issuing stocks, combination of the two. Now, turning to long-term debt, we'll get into it and we'll look at the debt ratios of corporations here. The higher the amount of the debt, the more risky it is. And if you're a banker and a company is asking to borrow more money and they have a high debt level, the company is either going to decline them or charge them a higher interest rate. Same thing even with equity financing. If the company has too much debt, the person deciding to purchase the company stock is going to require a higher rate of return to purchase that stock, because more debt you have, the more risk there is with that particular corporation. Then again, another slide here, assets, investment decisions. Up here is the firm and how much debt and how much equity, and these are the decisions the company will have to take. One good indicator, especially if you're a bank looking to loan money to a company, or if you're an individual, because an individual can also purchase bonds, is to see what the industry average for how much debt that particular industry should have and how much they should use with the equity side of raising cash for capital budgeting decisions. Okay, real assets are used to produce the goods and services of the company. Financial assets are like the common stock issued by the company or a financial loan made by a bank to the company. Okay, all of these are examples of capital budgeting or financial decisions. Intel decides to spend $7 billion to develop a new microprocessor. BMW borrows 350 million euros from the Deutsche Bank. Royal Dutch Shell constructs a pipeline to bring natural gas onshore to Australia. Avon spends 200 million euro to launch a new range of cosmetics in the European market, and Pfizer issues new shares to buy a small biotech company. So as you can see, there's many different types of decisions, either capital budgeting or financial decisions that a company would make. Okay, now turning from investing in financial decisions to what the definition of a corporation is. It's a business organized as a separate legal entity owned by a stockholder in the United States. Of course, these are corporations are organized in the different states. You have different types of corporations. You can have a public company, which is traded on the stock exchange. So if you purchase, let's say, 100 shares of Ford, that's a public company. And then there's the secondary market, which we'll go over in this course, which you can sell those shares if you should decide to delete or get rid of the Ford shares that you own. Of course, then there's a private corporations. And of course, these aren't traded. So if you're trying to sell shares of a private corporation, it's going to be a little harder. You're not going to have the secondary market to arrange for the sale of your share of the private company. And then, of course, there's the limited liability corporation, LLC. And we're going to talk about an LLP, limited liability partnerships, when we hit the partnership side for this chapter. Okay, let's turn to the different types of business organizations that you would see. Sole proprietorship, that means that you own the company yourself. You're legally liable for everything. So if the business does well, you'll prosper from all your gains. If it doesn't, they can actually come against your personal assets, such as your house and your retirement program. Then there's partnerships, which is the same as a sole proprietorship in the sense that you have unlimited liability. Corporations, which we just talked about. Of course, there's limited liability options. You can have the limited liability partnership or the limited liability corporations, or a lot of your professions, such as doctors, professional corporations. Limited liability, the owner of the corporations are not personally liable for its obligations. So it's separate between the stockholders in the company itself. Okay, let's turn to the three main forms that you'll see in this country here. The sole proprietorship, who owns the company. Of course, that's the owner, manager. In the partnership, it would be the partners in the partnership. And then with the corporations, it would be the stockholders. Let's see, are managers and owners separate? With the sole proprietorship, no. Partnership, no. And with corporations, usually. And as you can see, unlimited liability for the sole in the partnership with limited liability. Limited liability with the corporation means you're only limited to what you paid for the stock, but they can't come to your against you for your house, pension, or whatever if the company should go under. Are these owners and businesses taxed separately on the first two? Of course, that's no. And with corporations, of course, we know there's double taxation, or we'll get into that. The corporations are taxed, and the stockholders are taxed if they receive dividends. Okay, let's turn back to the corporation here. Who is the financial managers? Of course, with most of your large companies and even medium-sized companies, there's many people involved with the financial decisions. Of course, you'd know the finance department would be. But anyway, here are your three chief overseers of finance. Of course, there's your chief financial officer, CFO, and then your treasurer, and then there's your controller. Of course, your chief financial officer supervises all financial functions, sets out the financial strategy for the company, and your treasurer is responsible for financing, cash management, and relationships with banks and other financial institutions. And your controller is more of your accounting type of duties, responsible for budgets and coming up with budgeting, accounting, and taxes, which is basically your accounting functions. Okay, this is basically an illustration here of how money comes into a company. You have your investors over here in number one, and that's going to go to your financial manager. And then number two, that's going to go cash invest in the company. Of course, you have your real assets, and your cash generated by operations is going to flow back to the financial manager. Now, the company has two options. They can send money back with the 4B back as dividends to the stockholders, or they can take those retained earnings and reinvest them into the company. And there's advantages for that also, which we'll talk about in this course, having your cash reinvested. And that would be up to the financial manager if some's going to go to the investor and how much is going to flow back into the company. Of course, the goal of a company is to maximize the wealth for the company, which will maximize the wealth for shareholders. Of course, there's always, we're going to talk about some different scenarios here. Maximize profits, of course, that. Maximize year's profits, earning manipulations. Of course, there's the opportunity cost of capital. The minimal acceptable rate of return on capital investments is set by the investment opportunities available to shareholders in the financial markets. So if the shareholders, and we're going to go into this, can earn more money than the company should send those funds to the investor. Of course, if the company can return a higher return, it would be better for that money to be returned to the company, and the company will earn larger profits, which down the road will pay a higher dividend to the stockholder. And here's another illustration for the investment trade-off. You have cash coming to the firm, and they have two options. They can take that money and invest with investment opportunities or real assets with the company, or they can pay that out as dividends to the shareholders, then which the shareholder will have investment opportunities to invest their money in.